Hello, and welcome to today's webcast, Governmental Accounting Standards Board Updates. Before we begin, I am going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
With that, I'll turn it over to today's presenters to introduce themselves and get our webcast started. Arthur?
Thanks, Laura. Hi, everyone. My name is Arthur No. I'm a senior manager at Moss Adams, and I help lead our education not-for-profit practice. I also work in various governmental audits. Alla?
Thank you, Arthur. Hi, everyone, and thank you for joining our webcast today. My name is Alla Keidanska. I am Senior Manager at Moss Adams in Assurance Practice. I am working primarily with the tribal governments and their enterprises. And today, webcast will be with the main learning objectives related to scope and applicability, recognition, measurement, and disclosure requirements related to the most recent GASB statements, which are accounting changes and corrections, Statement 101, compensated absences, Statement 102, certain risk disclosures, and Statement 103, the most recent one, financial reporting model and improvements. We will start with the GASB Statement 100, accounting changes and error corrections. I believe there were already alerts and maybe webcast on this statement. However, since the effective time for this statement is fiscal year beginning after June 15, 2023, which means it's fiscal year ending June 30, 2024, September 30, 2024, or December 31, 2024, we believe this will be helpful to refresh this GASB Statement 100. And the primary objective of this statement is to enhance accounting and financial reporting requirements for accounting changes and error corrections to provide more understandable, reliable, relevant, and comparable information for making decisions or assessing accountability. The Statement 100 defines accounting changes as changes in accounting principles, change in accounting estimates, and changes to or within the financial reporting entity, and describes the transactions or other events that constitute those changes. As a part of those descriptions for certain changes in accounting principles and certain changes in accounting estimates that result from a change in measurement methodology, a new principle or methodology should be justified on the basis that it is preferable to the principle or methodology used before the change. That preferability should be based on the qualitative characteristics of financial reporting, such as understandability, reliability, relevance, timeliness, consistency, and comparability. The initial adoption and application of accounting principle to transactions or other events that are clearly different in substance from those previously occurring or are occurring for the first time or were previously insignificant in their effect are not considered a change in accounting principle. This Statement 100 also addresses corrections of error in previously issued financial statements. So a change from applying an accounting principle that is not generally accepted to transactions or other events that previously were significant to applying a generally accepted accounting principle to those transactions or other events would be considered an error correction. The Statement 100 requires that changes in accounting principles and error correction will be reported retroactively by restating prior periods. When changes to or within the financial reporting entity required to be reported by adjusting the beginning balances of the current period. Examples of the changes to or within the financial reporting entity are addition or removal of fund that results from the movement of continuing operations within the primary government, including its blended component units. Another example is a change in a fund's presentation as major or non-major. Also, example, the addition of a component unit to the financial reported entity or removal of a component unit from the financial reporting entity. And one more example is a change in component unit presentation as a blended or discretely presented. Changes such as acquisitions, mergers, or transfers of operations as defined by Statement 69 that result in the addition or removal of discretely presented component unit, and also a component unit reported following Statement 90 as majority equity interest, those should not be considered a change to or within the financial reporting entity. In regards of change in accounting estimates, those should be reported prospectively by recognizing the change in the current period. A change in the method used to depreciate capital assets or a change in the valuation technique used to measure fair value would be examples of change in accounting estimates resulting from the changes in measurement methodologies, providing that the new method or technique is preferable. The Statement 100 clarifies that accounting estimates are outputs, which are determined based on inputs such as data, assumptions, measurement methodologies. To help differentiate between a change in accounting estimate that results from a change in measurement methodology and other changes in accounting estimates, this Statement 100 includes examples to provide context for understanding the circumstances that constitute a change in the measurement methodology. So how to differentiate between a change in accounting estimate and error correction? The board determined that the distinction is that for an error correction, the government should have known facts at the time the financial statements were issued about conditions that existed as a financial statement date. And that is, those facts could reasonably be expected to have been obtained and taken into account. A key aspect of changes to inputs is that those changes arise from changes in circumstances or new information received or more experience. Accordingly, the objective of change to the inputs included measurement methodology would be a better estimator or output. As such, if the initial input was appropriate and did not ignore or misuse facts available at the time the financial statements were issued, then reporting the effects of change to an input, including a change to a new measurement methodology that is preferable, as a change in accounting estimate considered appropriate. The board also acknowledges that professional judgment may need to be applied to determine whether certain facts should have been known. Now, how it's required to be disclosed in required supplementary information RSI or supplementary information SI. Information for periods earlier than those presented in the basic financial statement that is affected by a change in accounting principle should not be restated in required supplementary information RSI or supplementary information. For a change to or within the financial reporting entity, because the beginning balance of only the current period are adjusted in the basic financial statement, so no prior period should be adjusted in RSI or SI. This statement 100 also requires that an explanation be provided in circumstances in which information presented in RSI or SI for prior period is not consistent with information for the current period. Such explanation should accompany the required supplementary information, including management discussion and analysis, or supplementary information to which it relates. Display and no disclosure. The statement 100 requires that the aggregate amount of adjustments to and restatement of the beginning net position, fund balance, or fund net position as applicable be displayed by the reporting unit in the financial statement. Presenting the aggregate amount of the adjustments and restatements by reporting unit in financial statements will facilitate users' understanding of the magnitude of the effect of accounting changes and error corrections, and would allow them to more easily determine whether they need to obtain additional information. The other common disclosure would include the nature of the change or error and its correction, and also reasons for the change. And the disclosure should be made in the period of the accounting change or error correction and need not be repeated in subsequent periods. So to summarize the biggest changes that Statement 100 has, overall, there are no significant changes to existing practices, but it rather provides a clarity to a few situations. However, there are a few important changes to keep in mind. The first one is the statement attempted to resolve an inconsistency in practice on how the change in accounting principle and correction of an error is presented in financial statements. So in regards to the change in accounting principle or adoption of new standards, changes should be presented in the current financial statement. Therefore, prior presented information should not be restated. However, correction of error should be updated for all periods affected in required supplementary information and supplementary information, and not just limited to the fiscal year presented in the basic financial statement. As such, it is important to think how far back that correction of error needs to be restated. And another significant change is when you have a change in reporting entity, such as a major fund going to non-major or the other way around. That Statement 100 requires those changes to be reflected on the face of financial statement, which historically was presented only on footnote disclosure. And it looks like we will have the first polling question now.
Thank you, Alla. Yes. Polling question number 1. What is your organization's current status on implementing GASB 101? A, we've got this already adopted. B, we're adopting this year and have a solid plan that's underway for implementation. C, we're adopting this year, but we're not sure where to start with implementation. D, I've heard of GASB 101, but need more information on how it might impact us. I'll give everyone a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. All right, we'll give everyone just a few more seconds to answer. And here are the results.
Great. So based on the first polling questions, you can guess that the next topic will be GASB 101 subject. And yes, results as would be expected. So now let's talk about the GASB Statement 101, which is about compensated absences. So what, why, and when related to the GASB 101? The objective of this statement is to better meet the information needs of financial statement users by updating the recognition and measurement guidance for compensated absences. This new guidance supersedes GASB Statement 16, Accounting for Compensated Absences, which was issued in 1992. And the aim of the new statement is to align the treatment of paid leave benefits for employees across different government entities. There is no significant changes to previous Statement 16, and the goal of Statement 101 is to provide financial statement users with improved and comparable information regarding compensated absences by establishing a unified model for recognizing and measuring compensated absences. And the effective date for this statement is effective for fiscal years beginning after December 15, 2023, and earlier application is encouraged. So what is compensated absences? Statement 101 defines compensated absence as a leave for which employees may receive one or more payments, and those are cash payments when the leave is used for time off, other cash payments such as payment for unused leave upon termination of employment, and non-cash settlement such as conversion to post-employment benefits. And examples of compensated absences you see are vacation and sick leave, paid time off, holidays, parental leave, certain types of sabbatical leave. Under the new model, a liability for compensated absences is recognized for two scenarios. The first one is unused leave, and the second is leave that has been used but not yet paid or settled. The first scenario, unused leave, there are three criteria must be met. The first one is the leave is attributable to services already rendered. So employees have performed the services required to earn the leave. The second criteria is the leave accumulates and carries forward to future reporting periods. So it can be carried forward from reporting period when earned to a future reporting period when it will be used or otherwise paid or settled. And the third one is it's more likely than not to be used for time off or paid or settled through non-cash means. Likelihood of that more than 50%. Factors such as employment policies and historical information should be considered when an entity assessing the likelihood of leave usage. Employment policy can affect key factors of assessing the likelihood of leave usage by influencing employee behavior and expectation regarding leave benefits. For example, some employment policies might have a use it or lose it rule, which means that employees must use their leave within a certain period of a period. Since this leave does not accumulate, it would not be recognized. Other employment policies might allow employees to carry over their leave indefinitely, which may decrease the likelihood of leave usage, as employees may prefer to save their leave for future needs or cash out upon termination. Since these amounts are paid out at termination, they would need to be accrued. Employment policy can provide useful information about the incentives and constraints that affect the employee's decision regarding their leave. Historical information also should be considered when assessing the likelihood of leave usage, since historical trends of employee leave usage are most likely to remain consistent. So using historical trends, employers can plan ahead for staffing needs as well as estimate the balance of the liability throughout the year. As with most standards, there are exceptions to the above guidance. The first exception is when leave is more likely than not to be settled through conversion to defined benefit post-employment benefits, that leave should be excluded from the liability, since the liability for those benefits is already recognized in accordance with Statement 68, 73, or 75 as applicable. The second exclusion is if leave is dependent upon the occurrence of a sporadic event that affects a relatively small proportion of employees in particular reporting period, such as a parental leave or military leave, then it should be recognized when the leave commences. This excludes those sick leave and sabbatical leave. Another exception is unlimited leave and holiday leave taken on a specific date should be recognized as a liability when used, because those types of leave do not meet the definition of liability. And that also includes unlimited policies. Measurement. Measurement of the liability involves using the employee's pay rate as of the financial statement date. Additionally, salary-related payments directly and incrementally associated with leave, such as payroll taxes, employer contribution to defined contribution post-employment plans, should be included also in the liability calculation when the leave has not been used. The second scenario, as I mentioned, would be leave used by not paid. When leave meeting the definition of a compensated absence is used for time off, then a government's obligation to allow employees to take time off has been satisfied. However, the obligation to allow for time off gives rise to another obligation, which is to pay the employees for that time. And since second obligation meets the definition of liability because it requires a payment, sacrifice of resources that the employee has earned, therefore the government has little or no discretion to avoid paying it. And because the payment or settlement generally occurs soon after the leave is used, government should know the amount of the payment or settlement to be made. Therefore, the board believes that further guidance regarding measurement on that liability is not really necessary. In determining which salary-related payments should be included in liability for compensated absences, the board decided to include those payments that are directly and incrementally associated with the compensated absence. The guidance on salary-related payments is broad and may encompass many types of benefits, so there is no specific list of which salary-related payments to include is provided in the Statement 101. The guidance on includable salary-related payments requires recognition of those items for which an employer is obligated to make an additional payment as a result of compensated absences, considering that additional payment is a function of the salary to be paid to employees. No disclosure related to the GASB 101. The guidance also revises the disclosure requirements for compensated absences. Governments now have the option to disclose only the net annual change in the liability for compensated absences rather than disclosing the gross annual increase and decrease separately. Additionally, the disclosure of the government funds used to settle the liability for compensated absences is no longer mandatory, and no new additional disclosure requirements. Now, just to summarize again, specific consideration and auditor perspective. So what's changing for government accounting? Overall, these criteria are not substantially different from the previous guidance, which required that leave be both vested and accumulated to be recognized as a liability. The term vesting does not appear in the new guidance, but it is similar to the first and third criteria, stating that the leave is attributable to services already rendered and that it's more likely than not to be used or paid or settled. An example of how this differs from the current method of accounting for compensated absences comes in the form of unvested sick leave, which is not paid upon separation. Presently, governments do not recognize a liability for such leave time. However, the new guidance requires governments to assess how much of this leave will be used, regardless of whether that leave is paid out at separation. The second criterion, which states the leave accumulates and carries forward to future reporting period, is consistent with the previous definition of accumulated leave. And as I mentioned earlier, the new guidance does not introduce a significant change in the recognition of liabilities for compensated absences, but rather clarifies and simplifies the conditions for recognition. And as always, it's a good practice to document assessment of how you determine whether it meets the three criteria for each type of leave considered. And also, as with all other GASB standards, GASB 101 does not apply to immaterial items, but you may still need to assess and validate to auditors that it would not be material. And looks like we are into our second polling question.
Great, thanks, Alla. Yes, polling question number 2. Which GASB standard is being replaced by GASB Statement 101? A, GASB 62, B, GASB 16, C, GASB 47, D, GASB 65. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Okay, and we'll give people just a few more seconds to respond. And here are the results.
Oh, great. I see that at least almost 50% participants are listening, and yes, it was GASB 16. So now I will pass forward to my colleague Arthur. Arthur, now it's you.
Thanks, Alla. So we will now cover GASB Statement 102, certain risk disclosures. Let's start off with understanding the what, why, and when related to GASB 102. State and local governments face a variety of risks that could negatively affect the government. Although governments are required to disclose information about their exposure to some of these risks, essential information about other risks that are prevalent among state and local governments are not routinely disclosed because they are not explicitly required. The objective of Statement 102 is to provide users of the government financial statements with essential information about risks due to certain concentrations or constraints. Stakeholders asked the GASB to address this issue. This is why GASB Statement 102 was issued. The statement is effective for fiscal years beginning after June 15, 2024. An earlier application is encouraged. So this is applicable for fiscal years ending June 2025 or calendar year ending December 2025. First, let's talk about the definition and examples of concentration and constraints. The GASB defines a concentration as a lack of diversity related to an aspect of a significant inflow of resources or outflows of resources. And an example of inflow of resource is revenue, and an example of outflow of resource is expense. And the GASB defines constraint as a limitation imposed by a government by an external party or by formal action of the government's highest level of decision and authority. Concentrations and constraints may limit a government's ability to acquire resources or control spending. Some examples of concentration includes, but not limited to, 1, the composition of employers, industries, inflows of resources, workforce covered by collective bargaining agreements, providers of financial resources, and suppliers of materials, labor, or services. And very similar to, related to constraints, some of the examples includes, and not limited to, limitations on raising revenue, limitations on spending, limitations on the incurrence of debt, and mandated spending. The disclosure criteria is applicable to the primary government reporting unit, including its blended component units, and other reporting units that report a liability for revenue debt. So when are the disclosures required? So it's required when a concentration or constraint is known to the government prior to the issuance of the financial statements. It also is required when the concentration or constraint makes the reporting unit vulnerable to the risk or substantial impact of a substantial impact. Or lastly, an event or events associated with the concentration or constraints that could give cause to substantial impact have occurred, have begun to occur, or more than likely not to begin or to occur within 12 months of the date of the financial statements issued. One thing to note is that if there are mitigating actions taken by the government prior to issuance of the financial statements cause any disclosure criteria not to be met, none of the disclosures are required. So you need to look at mitigating factors as well to determine whether or not the disclosures are required. Information related to government's exposure to certain concentrations or constraints should be disclosed in the notes to the financial statements according to the following principles. If your government agency or entity presents comparative financial statements, the reporting requirements only apply to the financial statements of the current period. You do not need to disclose comparative information for concentrations or constraints. Certain disclosures required by Statement 1 and 2 may supplement note disclosures required by other authoritative guidance. If this is the case, the information required to be disclosed by Statement 1 and 2 should be combined with those disclosures in a manner to avoid duplication. If your organization has multiple reporting units, make sure that the disclosures are made for all units. The information should be combined to avoid unnecessary duplication. The disclosure information is subject to the requirements in paragraph 63 of GASB Statement 14, which talks about considerations for discretely component units and notes essential to the fair presentation in the reporting entity's financial statements. So disclosure requirements is to provide the description of the concentration or constraints, if they have occurred, a description of each event associated with the concentration or constraint that could impact or cause a substantial impact on the financial statements, and a description of the actions taken by the government to mitigate the risk. So those are the required disclosures if you are required to disclose a constraint or concentration. Again, the effective date for this GASB Statement 102 is for fiscal years beginning after June 15, 2024. Some specific considerations. Some organizations often issue fund, department, component unit, and other standalone statements. The disclosures may not apply to all the entities. An example is a grant fund financial statements with no liability for revenue debt. It isn't a primary government, so the disclosures would not apply to that grant fund. The more than likely than not criteria is helpful and may eliminate some disclosures that are previously included. Some examples includes a casino disclosure of regulatory risk environment. If the changes to regulations aren't known, a disclosure would not be required. Another example is a department financial statements disclosure and concentration of grant revenues on profit distributions from casinos to fund operations would not generally be required. So the process to go about identifying it may go beyond just your finance staff. So you need to consider whether or not an annual evaluation should be done with the CEO, the general manager, legal counsel, governing body, and others within your organization. For the next topic, we'll cover GASB Statement 103, financial reporting model and reexamination. But before we dive into it, it looks like we're coming up to the next polling question.
Thanks, Arthur. Yes, polling question number 3. Which is the most significant challenge you faced or anticipate facing during the adoption of GASB 103? A, the modifications to management's discussion and analysis. B, presentation of unusual or infrequent items. C, presentation of the proprietary fund statement of revenues, expenses, and changes in fund net position. C, reporting of major component unit information and budgetary comparison information. For those of you who would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts. We will also be sending the slides via email after the webcast along with a recording. Okay, and we'll give people just a few more moments to respond. And here are the results.
So it looks like most of the attendees responded MD&A followed by unusual and frequent items. So I did talk to a lot of my clients. None of my clients have implemented because this isn't effective until 2026 for their financial statements, but it is consistent with the response. MD&A and unusual and frequent items are the items that would cause most challenge to the organizations I audit. Related to GASB Statement 103, the objective of Statement 103 is to improve key components of the financial reporting model to enhance its effectiveness in providing information that is essential for decision-making and assessing a government's accountability. This statement also addresses certain application issues. The statement establishes new accounting and financial reporting requirements or modifies existing requirements related to the following: the MD&A, unusual and infrequent items, presentation of the proprietary fund statement of revenues, expenses, and changes in net position, information about major component units in the basic financial statements, and budgetary comparison information. The board believes that the expected changes from the statement will result from the believes that the expected benefits that will result from the implementation of this statement will result in more comparative, consistent, relevant, reliable, and understandable information. The requirements of the statement is effective for fiscal years after June 15, 2025, or fiscal year 2026, or calendar year ended December 31st, 2026. Related to the MD&A, users of the MD&A have different levels of knowledge and sophistication about the governmental accounting and finance, may not have a detailed knowledge of accounting principles. The analysis of the current year balances and activity to explain why the balances and result change from prior year. And the MD&A update avoids unnecessary duplications and avoid boilerplate language. And it focuses on the primary government discussion of discretely presented component units is a matter of professional judgment. So some of the required elements of the MD&A includes an overview of the financial statements, a financial summary and condensed financial statements, a detailed analysis of the primary government's financial position, the results of operations, which includes both governmental and business type activities. In addition to the amounts and the percentage of change, organizations are required to explain why the change occurred, fund balance from that position, and the results of operations of each major fund. The non-major funds are not required to be included in your MD&A. So very similar to the primary government's business type and governmental activities, you need to include the amount and percentage of change and explain why the change occurred. The MD&A also needs to include significant capital asset and long-term financing activity. Related to capital asset activity include intangible capital assets. You also need to include a discussion of significant additions and disposals to the organization, discussion of the significant policy changes and economic factors that affect your capital assets for the year, and avoid duplication between analysis and this component. In relation to the long-term financing activity, this includes debt, leases, PPPs, and subscription-based IT arrangements. You also need to include in your analysis any discussions of new agreements, any changes to credit ratings, and a debt limit. You also need to include a discussion of significant policy changes and economic factors. And very similar to capital assets, avoid duplication between this analysis and other areas. The MD&A also needs to include currently known facts and decisions and conditions that are expected to have a significant impact on the financial position or results of operations in the subsequent year. Your MD&A also needs to include a trend in relevant economic and demographic data, factors used to develop the subsequent year's budget, which includes those affecting revenues available for appropriation, those affecting planned spending, such as inflation, labor contracts, or changes in programs. Any expected changes in budgetary net position or fund balance. And then actions taken related to post-employment benefits, capital plans, leases, PPPs, subscription-based IT arrangements. These are all long-term items. So any significant or material items that would have impact on your long-term financing activity. And then also needs to include other actions parties have taken, such as any new laws or regulations that might have an impact on your organization. Some specific requirements or considerations. The MD&A is considered required supplementary information. When you look at the auditor's report, the audit opinion is not provided for the MD&A, but the auditors are responsible for reviewing the MD&A and reporting any errors or omissions related to the MD&A. Changes do not impact an organization's decision to exclude the MD&A from their financial statements if they have elected to exclude it in the past. The auditors are required to modify the paragraph of their auditor's report and highlight if there are any material departure with the prescribed guidelines. So they'll look at, auditors are required to look at the different elements that we just covered and make sure that they're all included in the MD&A. So if there's any omissions or any departure with that, the audit opinion is modified to reflect the departure omissions of those items. The auditor is also required to modify the paragraph of the auditor's report if they're unable to complete the limited procedures required. And then lastly, if the auditor has unresolved doubt about whether the RSI is presented in accordance with the prescribed guidelines, that would also require the auditor to modify the paragraph within the auditor's report. For those organizations that include the MD&A, there may be some more auditor questions this year, or when the statement is effective, related to whether they have adequately changed, why something has changed, and currently known facts and decisions that are included in the MD&A. So look for more questions as you implement this statement from the audit team. Related to unusual and infrequent items. Unusual and infrequent items are transactions and events that are unusual in nature or infrequent in occurrence. GASB Statement 62 defines the terms unusual in nature and infrequency of occurrence. The statement requires governments to separately present inflows and outflows of resources that are unusual in nature or infrequent in occurrence, replacing extraordinary and special items. In the notes to the financial statements, governments should disclose the program, function, or identifiable activity to which an unusual or infrequent item is related, if applicable, and whether that item is within the control of government of management. So organizations will use the existing guidance for unusual in nature and infrequency of occurrence. So you refer to GASB Statement 62 to define those items. Some considerations from the auditor's perspective as well related to unusual and infrequent items. This is a really high bar to meet. We expect to see very few items related to unusual and infrequent items. Likely does not include things like insurance proceeds, settlement agreements, or COVID-19 related activity. There is a GASB technical bulletin that talks about the COVID related items. And it looks like we're coming up with one more polling question.
Thanks, Arthur. Yes, polling question number 4. Which new GASB standard do you believe will have the most significant impact on your organization? A, GASB 100, accounting changes and corrections. B, GASB 101, compensated absences. C, GASB 102, certain risk disclosures. C, GASB 103, financial reporting model improvements. Once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window. Okay, and we'll give everyone just a few more seconds to respond. And here are the results.
Yeah, that's consistent with my expectations as well. GASB 103, especially with the changes to the MG&A requirements and the unusual and frequent items in the proprietary statements. Those are things that will affect most of my clients. So GASB 103 with the most results or the most votes. Next, we'll talk about the changes to the proprietary fund, the presentation of the proprietary fund statement of revenues, expenses, and the changes in fund net position. Before we do that, let's go over the definition of operating, non-operating, and subsidies. Operating activities include activities other than non-operating activities, so it's pretty easy enough, straightforward, everything other than non-operating activities. Non-operating activities includes subsidies received and provided, revenues and expenses of financing, gains or loss from the disposal of capital assets and inventory, investment income or loss, contributions made to endowments, and then subsidies are defined as resources received from another party or fund for which the proprietary fund does not provide goods or services to another party or fund, and that directly or indirectly keep the proprietary fund's current or future fees or charges lower than they would be otherwise. And then B, resources provided to another fund or party or fund for which the other party or fund does not provide goods or services to the proprietary fund, and that they are recoverable through the proprietary fund's current and future pricing policies. And lastly, includes all other transfers. Statement 103 requires a separate presentation of operating and non-operating revenue and expenses, and separately report non-capital subsidies. So that's the change with this statement, is that the non-capital subsidies are now reported as a separate area in your financial statements for the proprietary fund. In the proprietary fund statements, you'll have a new subtotal for operating income or loss and non-capital subsidies. We have an example of this presentation in the next slide. So this is an example of the statement of revenue, expenses, and changes in fund position. So you'll see that highlighted, there's a new subtotal for operating income, loss, and non-capital subsidies. You'll see right above that, there's a section for non-capital subsidies, transfers in and out. So that's new with the statement 103 is the non-capital subsidies. Some specific considerations and auditor's perspective with this new statement, it may require additional explanations to users of the financial statements as the presentation looks a little bit different. Organizations may want to ensure it does not impact the calculation of debt covenants or require change to any terminology in those calculations or agreements. So something that you might want to get in front of with your financial institutions, look at your debt covenants and see if any of those financial statement line items are impacted. For casinos and other entities preparing comparative financial statements, look to Statement 100, accounting change and error corrections by restating all prior years presented. For subsidies, it includes transfers, grants, and other appropriations and profit distributions. It can be inflows, for example, from tribe to the business enterprise, or outflows, the business enterprise to the tribe. consider ensuring documentation includes information to determine if it's a capital related item versus non-capital, because remember, in the financial statement presentation, it's non-capital subsidies that are broken out in the income statements. And then just some other changes that are impacted with the Statement 103, information about major component units and basic financial statements. In basic financial statements, government should present each major component unit separately in the reporting entity statement of net position and activities if it does not reduce the readability of the statements. If presenting each major component unit separately in the reporting units statements of net position and activities reduces the readability of the statements, combining statements of major component units should be included in the reporting entity's basic financial statements after the fund financial statements. So you have to consider whether or not it impacts the readability of the financial statements for the major component units. If so, then you include those statements in the back of the financial statements after the fund financial statements. For budgetary comparison information, the budgetary comparison schedule should be presented as RSI for the general fund and each major special revenue fund that has a legally adopted annual budget. So this is no change from what governments are doing currently. A separate column for variances between original and final budget amounts, and then the final budget amounts, actual amounts are required to be presented. So before Statement 103, the requirement was just a column for variances between final and budget, or final and actual amounts, but now you're also required to include variances between original and final budget amounts. You also need to include an explanation for significant variations between original and final budget amounts and final budget amounts and actual amounts. It's required to be disclosed in the notes to the RSI. With that, I'll turn it over to Laura to close this out.
Thank you, Arthur and Alla, for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. Feel free to reach out to any of our presenters if you have any additional questions. Also, please be sure to join us for our next webcast this Thursday, July 18th at 10 a.m. Pacific Time, Increase Impact by Clarifying Board Roles and Responsibilities. You can click on the image in the upper right-hand side of your console that will direct you to the webcast page if you would like to register. We invite you to visit our website for more resources and information on this topic, many of which are linked in your handouts window. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading now. Finally, here is a link to a survey for today's presentation. Your feedback is always appreciated. Again, thank you for joining us, and take care, everyone.